It is 9 a.m. Good morning, everybody. For those who have not met, I am Terry Caddo, President and CEO of the Burlington Chamber of Commerce. I am pleased to welcome you to our 2021 economic forecast presented by RBC. As I settle into my new role, I've had the great pleasure of meeting many of our members and key partners. This includes Peter Choma and Jeff Bradley with RBC. The folks at RBC really embrace the notion of partnership, and for that, I'm truly grateful and look forward to working with you even more. As we start today's session, I'd like to acknowledge the Burlington Chamber's respect for the rich and vibrant culture of our Indigenous people. We wish to honor the original people of Turtle Island as we recognize their homelands as a sacred and spiritual place known since time immemorial. In the spirit of partnership and reconciliation, we acknowledge that our membership resides on a variety of territories and homeland. At this point, I would like to introduce Peter Choma, Vice President, Commercial Financial Services, Halton South Region with RBC Royal Bank, to introduce our guest speaker. Peter?
Thank you, Terry, and good morning, everyone. RBC is once again pleased to bring the Burlington Chamber membership this event, as it has certainly become a staple for both of us. This year, we are pleased to have senior economist Robert Hogue with us virtually to provide us with the economic outlook for 2022. 2021 has been yet another year that has tested us more than any other time in our generation. As we prepare to enter a new year and a constantly changing world in 2022, how we continue to operate our businesses, interact with our consumers, engage our communities, and live our lives will continue to evolve. And that's why I'm so pleased that we have Robert here today for this timely conversation. Robert Hogue is a member of the macroeconomic and regional analysis team with RBC Economics Research. He's responsible for providing analysis and forecasts for the Canadian housing market and for the provincial economies. His publications include Housing Trends and Affordability, Provincial Outlook, and Provincial Budget Commentaries. In his functions, he is frequently called to comment on the economy both internally within RBC and externally with clients in the media. Robert joined RBC in May of 2008 after spending 15 years with another Canadian FI as a senior economist specializing in industrial analysis. At the outset of his career, he spent 4 years as an economist with Ontario Hydro, where he specialized in industrial and macroeconomic analysis. Robert holds a master's degree in economics from Queen's University and a bachelor's degree from the University of Montreal. Over to you, Robert, and welcome.
You're on mute.
Oh, Robert, you're muted.
All right, is that better now? It's a classic. It's a classic pandemic thing here. No, I thought I had unmuted myself. Anyways, thank you, Peter, and good morning, everyone. I'm very pleased to be giving our thoughts here on where we are on the economy and where we're going. As Peter mentioned, I mean, the last now 20 months has been absolutely kind of crazy, but fortunately what we've seen over the last little while is that now we're getting traction in the economy. Now we're still very far from out of the woods with respect to the pandemic, and we're still seeing some consequences of it, and including some new worries, at least from what I can hear this morning's on the news from overnight with new variants popping up in Africa and other parts of the world. So clearly the pandemic is still top of mind, as a society, but also from an economic perspective as well. But still, we've made tremendous progress. Obviously, the vaccination has been, in our view, up until I guess this morning's news was a game changer. It allowed the reopening of our many parts of the economy and put us on a very clear a path towards a full recovery very soon, and in some sectors actually we've already have already seen a full recovery. But still, there are still some risks out there. There's still a lot of challenges, and one of them, obviously, which has been, I guess, the most talked about topic more recently, has been inflation. Which is something that I have to confess I had not been talking about to audiences for years and years, because inflation was a pretty boring story. Always kind of around the 2% mark. It would move a little bit higher, a little bit lower, depending on where we were in the cycle, but really was not the kind of newsworthy kind of economic indicator. And here we are today. It's where it's pretty much all about inflation. So let's jump right into it. If you can move the slides to the first one here, and just illustrate how quickly inflation has flared up. As of October, the rate of inflation across Canada was 4.7%, the highest that we've seen since 2003. And clearly this will have raises a lot of concern, but also could potentially have a lot of implications on a number of fronts, but including on the monetary policy. And that flare up in inflation, to be fair here, was not unexpected. It was pretty clear that the sharp drop in prices in certain commodities or certain consumption items early in the pandemic would set the stage for some kind of what economists call the base effect at later on, which is pretty much now. And the base effect is if essentially inflation is a comparison of the prices of a basket of goods and services compared to a year ago, right? It's the rate of change, and when your comparison point is very weak, it stands to reason that the number you get that change will be quite strong, which is a good part what we're seeing now. But if we can move to the next slide, I mean, in terms of the level of that CPI, that consumer price index, whereas the base effect was clearly up until a few months ago the main factor, it no longer is the case now. That level is now above what the trend line would have been. So there's clearly more than just base effect taking place, and clearly anyone in business knows that we're seeing inflationary pressures popping up pretty much everywhere. And a good part of that is the result of the supply chain disruptions that we're seeing around the world, including in transportation. There's tons of stories out there about ports not being able to carry all the loads and having containers piled up on docks, especially in the US, but elsewhere there's just not enough containers around, or the containers are in the wrong places in the world. So there's clearly some difficult challenges on that front that, in the context of a very strong global demand, especially for goods, is creating this kind of perfect storm for higher inflation. If we can move to the next slide, and clearly when you look at, excuse me, the sources of inflation for that 4.7% increase in October, when you decompose it, you quickly see that energy prices, so the cost of gasoline is affecting, as bumped up transportation costs tremendously. But also we're seeing the impact on this very hot housing market that we've been having over the past year, pushing up shelter costs, and those are probably likely to persist for for a little longer, but also some pressures on food prices and other kind of consumption items. So clearly this is this is the pressures are concentrated in certain items, but are also present in on a widespread basis. So clearly, inflation is an issue now. As the Bank of Canada puts it, those pressures will be transitory. Now, transitory does not necessarily mean kind of short-lived and in 4 to 5 months we'll be out of it. And in fact, our view is that inflation will be above the 2% target by the Bank of Canada through quite possibly through all the way to 2023. If we can move to the next slide, which it shows here our view up to the end of 2022, and we're currently working on our forecast to extend it to 2023. And I can tell you at this point we're penciling in inflation on above 2% through 2023 as well. So, but by transitory, as the Bank of Canada puts it, what we mean is that it's non-permanent. It's not like 3 or 4 years from now, where we don't expect inflation to be above the 2% target, and it will converge back to around 2%. And part of it will be because policy will adjust to ensure that it will be back to 2%. By policy, it's mostly monetary policy, but we'll also see some moderation on the fiscal side.
Sasha
and we'll
has,
probably get
some work from me that could.
If I can ask everyone to be muted, please. So fiscal policy, we'll get a bit more later in the coming weeks from the federal government when it releases its fiscal update. But we're likely to see less stimulus coming over time because the economy is on the stronger path. So the bottom line there is that that flare up in inflation is going to persist in the near term, but will run its course through 2022 and 2023, and eventually converge back to 2%. Now, that being said, I think really, if we think of policy, and especially monetary policy, really the important point will be about long-term inflation expectation, which is ultimately what the Bank of Canada based its interest rate policy on. And so far, those longer-term expectations have been still pretty well anchored around the 2% mark. So this provides the Bank of Canada with some room to maneuver here to leave interest rates low for the time being without really falling behind the ball here on the inflation front. I think we would get in trouble where, for those who were around in the late 80s, for example, if those inflation expectations were to rise to, say, the 4 to 5 to 6% range, for example, in which case the Bank of Canada would have to really rein in those expectations by jacking up interest rate a lot more to bring them down to around the 2%. So at this point, the fact that longer-term inflation expectations are still anchored around 2% allows the Bank of Canada to maintain its interest rate policy exceptionally low to continue to stimulate the economy. If we can move to the next slide, which is really shows our views on interest rates here. At this point, we expect the Bank of Canada to raise interest rates starting in next spring, and it will proceed gradually. We expect the Bank of Canada to raise interest rate 3 times in 2022. Now, I'm not showing here 2023 yet because we're having kind of nailed down our numbers, but that hiking cycle will continue through 2023. And our tentative view at this point, or preliminary view at this point, is that the Bank of Canada will raise interest rate another 3 times in 2023. So for a total, and each time raise it by 1/4%. So from the 1/4% right now, very close to zero, we're expected to boost it to 1% by the end of next year, and then to another to get to sometime 2023, probably around the 1.75%. Which is, now there's a big debate here, which may be the terminal rate in a way, in the sense which would be considered what economists call the neutral rate, which is kind of the steady state where it does not, neither stimulate the economy or restrain the economic growth. So this is more or less the kind of the broad sort of ballpark that we expect eventually interest rate to land on. That being said, longer-term interest rates have already started to move up. You know, we've seen bond yields in recent months starting to pick up, and on that front, and typically the financial markets are a little bit ahead of the of central banks here. So the anticipation of upcoming interest rate hikes from central banks prompt financial markets to price them in already. So we've seen that taking place to a certain extent, and then those long-term interest rates, for example, the 10-year bond yield is going to move slightly higher on a go-forward basis. Again, those types of increases, I want to be clear here, will be sort of gradual. The Bank of Canada will not, unless there's no really longer-term expectations start to move up unexpectedly. The Bank of Canada will be in no rush really to jack up interest rate, and will proceed cautiously and making sure that the recovery remains solid and will not get derailed by a higher cost of borrowing. If we can move to the next slide. Now, we have to understand here that this is this kind of the start of this renormalization of interest rate, and the presence of higher inflation really is in the context of an economy that is recovering. If you just look at Canada's labor market, what we've seen is, and it's a bit symbolic, but in September, Canada's employment returned to pre-COVID level. I don't want to imply here that we're back to normal here, because there's still a lot of businesses and industries that haven't fully recovered yet. But in aggregate, now we're back to where we were pre-COVID. So clearly, there's been a lot of progress made. And when we look at a number of sectors I've mentioned earlier, some in some cases have moved above where they were pre-COVID, construction, for example. So now we are on the right path. If we can move to the next slide now. But that being said, that path is not a smooth process here. And I think the second quarter of 2021 was a clear illustration of that, when we saw the economic activity contract during that period. Now, we did expect that. At the time was the third wave that had prompted some further restrictions, and supply chain disruptions were really becoming an issue at the time. So, most of us clearly expected some kind of weakening, but we were a little bit taken aback when the official number showed a contraction. Now, as I said, the recovery is in motion. We don't believe that the second quarter contraction is the start of a double dip recession, but our view is that that little bump that we saw will be very transitory, and in fact, we're expecting a fairly robust rebound in the third quarter and through the rest of 2021. But clearly, it drills home the point here that even though our forecasts look pretty smooth, but that's just the mechanic of doing forecasts, we have to expect some kind of volatility around there, some kinds of bumps. It's just not the economy does not behave so smoothly all the time. So this is we have to be prepared for some setbacks along the way. If we can move to the next slide, and part of the reason we're and clearly for Ontario and the region of Burlington, more specifically on the manufacturing side, those supply chain issues are a big deal. We've seen manufacturing sales, and particularly in the auto sector, having declining through a good part of 2021, and this is not for a lack of demand. There's tons of demand out there. This is clearly in the supply side that's unable to meet that demand. We've seen in the other sectors, for example, some shutdowns of assembly plants, and then also with obviously some implications for parts manufacturers. And we have to expect possibly some further disruptions on going forward. That's simply a reflection of those supply chain issues. Now, how long can those supply chain issues last? I mean, it's very, very hard to tell, because this is extremely complex. Where it's either the production of microchips in the auto sector, for example, more specifically, that the industry has fallen behind because of huge demand out there and limited supply. Now, there's chip manufacturers are new mega plants in the US as elsewhere to respond to this, but those may not come online very quickly. But those transportation bottlenecks are also being addressed, but it's unclear at this point when those will be cleared. So our best guess is that probably by mid-year next year, we'll see, for example, in terms of shipping bottlenecks, will start to get those containers will start to flow much more smoothly. But there is clearly a lot of uncertainty around there. So I think we have to be prepared for some more challenges or continued challenges on this front for some time. So, but eventually, when those will get cleared, again, demand is there. So it'll just be an issue of producers, manufacturers, the wholesalers, just to be able to ramp up and meet that demand. So many of the activities that have not been taken place due to those issues have been displaced in time and will take place. So we're pretty confident that in Ontario and in the region, in the Southern Ontario region, heavy in manufacturing, more specifically, I think we'll stand to see a big, a ramp up in activity a little bit later on. Again, the timing may be a little bit difficult to get right, but this will be coming in our view. If we can move to the next slide. And part of the reason up until, I guess, this morning, we were pretty confident that we were not entirely in the clear, but certainly we made enough progress so that authorities would not have to reimpose restrictions down the road. So therefore, allowing every parts of the economy, especially those high touch industries that had to be shut down for an extended period of time, to stay open on a go forward basis, now led us to believe that, okay, we're going to see that broadening of growth thanks to vaccination. Now, with the new variant, of course, it raises potential questions on that front. Now, so my understanding is still premature to pass judgment on whether we're going to have to resort to restrictions, but clearly what the news that we've heard overnight might be to be a bit worrying. If we can move to the next slide. So allowing the sectors to reopen more fully, in our view, will allow also a certain rotation in consumption patterns for consumers, from heavily into goods through up until now and through the early stage of the recovery, towards much more on the services side, especially those that had to shut down, and therefore consumers really built up some pent-up demand here. think of, restaurants, movie theaters, and hockey arenas and what have you. So we're expecting that broadening of the recovery going more and more into services, not to suggest here that goods consumption is going to drop, but it's just going to be complemented much more with services. And the reason why I'm stressing here the consumer, if we can move to the next slide, is that the Canadian households are in a very strong, in aggregate, overall, a very strong financial position, and which is absolutely surprising if you think back, 20 months. I think at just before the COVID, the bigger concern or the bigger vulnerability in the Canadian economy, as the Bank of Canada had been saying for a number of years, and we were on the same wavelength on that, was the household indebtedness that had reached records. And so the concern was, if there's a big economic shock, the household debt is going to put a lot of people in trouble, and this may start potentially a kind of a downward spiral, maybe not quite as severe as what we saw in the financial crisis in the US, but sort of along those lines. So that was the concern, and what we've experienced through COVID, really, it was the biggest economic shock in our generation, very compressed. And yet here we are today with the household balance sheet in a better shape than it was pre-COVID. Now there's a number of factors behind this, and it's our view is that it's unlikely to stay that good for long, but nonetheless, we are far from a dire situation here, and in large part it is because the household have received tremendous support from governments, especially the federal government, but also the other levels of governments have contributed very positively. So those huge transfers have provided a huge buffer against this shock. And in fact, if we can move to the next slide, what this has contributed to is that households have accumulated a huge savings through the pandemic, in large part because of those transfers, but also because of the fact that households have not been able to spend the way they would have normally. And so all the vacations that they haven't made, the travel that they had to cancel, they didn't do or spend on, were kind of put aside, directed to other things like housing in particular and home renovations. But the bottom line here is that there's a lot of savings out there to the tunes of hundreds of billions of dollars here that constitute that represent a tremendous firepower on a go-forward basis. So this good shape of consumer, in our view, will mean that consumers will be the big engine of growth, the way we've seen it up until now. But we'll continue to drive this economy forward over the next year through consumption. Again, some rotation, a bit more towards services, but then this is going to get that economic wheel going. If we can move to the next slide. And keep the housing market reasonably strong. As I mentioned, that huge saving or those spending avenues that were shut down prompted Canadians to turn and the time they spend at home to look at their current housing situation, and many have concluded that they have to make some changes. They either change their existing home or decide to move to a different home entirely, and this created tremendous demand for housing. The housing market has boom, reached record highs, and through the fall of last year and early part of this year to clearly unsustainable levels here. What we've seen through the spring and summers was some kind of cooling, still very robust activity, but cooling. And then we were surprised in September, October with another kind of tick up in activity, which in our view, we're not quite sold on the fact that this may be a start of another spike in activity. We think rather is that the start of, we've seen interest rates starting to rise, mortgage rates starting to rise, that it might have been triggered a little bit of a stampede on the part of some buyers to get going and lock in lower rates before they rise, because obviously low interest rates were a big part of this run up in housing activity. So we're still of the view that the housing market will stay strong historically, but will continue to cool relative to the record high levels that we had seen earlier this year. If we can move to the next slide, and obviously this will have also implications for home prices, that after prices moving up in some markets, including in the Burlington area, into the 20 and 30% increases on a year-over-year basis. Now we expect those rate increases to moderate, despite what we've seen a little bit of a reacceleration through in this fall. We don't think this will be sustained. The market, in our view, will continue to moderate. We'll reach a better balance by the latter stages of 2022, which will allow prices to flatten at that point. Now, flatter prices does not mean that prices are coming down. So, the 20 to 30% year-over-year increase that we've seen in prices will not be reversed. Especially in the large urban areas, there might be some smaller areas, smaller markets where we might see a little bit of reversal of those gains. But those higher prices are likely going to be, we expect them to be sticky. All we'll see is prices kind of flattening and reaching a more kind of a steady state thereafter as markets rebalance. So if we can move to the next slide. And a big part of the housing story here is that, there's just not enough supply out there. And I'm sure anyone who's looked at that, either we're on the market or have heard of people in the market, it's just not enough sellers. There's a clear pressure coming from that, but this is where we expect that with a cooling demand over the coming year, as interest rates start to rise, as affordability issue. I think if we can move to the next slide, I think I'm showing affordability. Our affordability measure here, as affordability continues to deteriorate, really limits a number of buyer, or especially first-time home buyer, moving into the market. This will have a sort of a rebalancing impact. If we can move to the next slide. This is and at the same time, when I'm saying there's just enough supply out there, this is not to say that builders have been staying idle here and not doing anything about it. And in fact, it's quite the contrary. What we've seen over the last 12 months is that it's the biggest surge in housing starts that we've seen since the mid 1970s. So there's clearly has been a builder response, and those units will eventually come to market. The thing is, it takes a while for those units to be completed for a whole bunch of reasons, including capacity issues. but also the fact that, especially in large urban areas like the GTA, a lot of those units are not single detached homes. They are condos or projects that take years to complete. Because of the nature of the type of units that are being built, it's going to take a while for those for that supply response to really become ready for people to move in. So, but as we get through, through time here, again to 2022, we do believe that completions will start to move up and then potentially move up quite materially. So this will help rebalancing that the housing market. If I can move to the next slide. And this is, and again, it's tied to the labor, to the housing market, but it's also at large. I mean, those exceptionally tight housing market occurred at the time when immigration pretty much fell to down to zero, not quite, but almost. And as I'm sure you know, immigration has been a great source of housing demand over the past decade or even more, especially in the GTA. And now we're seeing immigration starting to come back. So all the more reasons for the supply side to get going, to build even more, because not only immigration is starting to kick back into gear, but it will move to higher gear in the coming years, because the federal government has increased our immigration target significantly to over 400,000, and even in 2 years' time, moving to more than 220,000, which will be, easily the highest level possibly ever, if not going back to the 60s, if I'm not mistaken. And so this will create tremendous pressure on the housing stock again, coming from immigration. So that's another element here to keep in mind. But immigration will have other I guess impacts on other aspects of the economy, especially on the labor market side, because as I'm sure you know, and I'm pretty much everyone in business I talk to, everyone's complaining about looking for labor. I was talking just a couple of minutes ago about a lack of supply of housing, but there's also a lack of supply right now of labor. There's the labor shortage is pretty much everywhere. So stronger, and this is a big part of the idea here from the federal government to up its immigration targets. It is to address those labor shortage issues and need for a growing economy on a go-forward basis. So this is, in that sense, good news to see immigration come back, but this will help alleviate the pressures in the labor market. If we can move to the next slide, and those pressures will get even more intense. We expect the unemployment rate in Canada to continue to decline. So the pool of available workers is going to continue to shrink. And we're not quite to where we were pre-COVID, noting that pre-COVID, the unemployment rate in Canada was at decades at a generational low, and clearly probably a little too low, because we were already seeing some we were facing labor shortage challenges at the time. Now we're probably by mid-year next year we'll be very close to where we were pre-COVID. So clearly pressure is going to continue to build on the labor side. If you and your organizations are facing some challenges on that front, don't think those will dissipate very quickly. You need to think of strategies to attract and retain. That's pretty a given. Immigration will help, but it's not going to be your kind of a silver bullet answer to everything. So keep that in mind. If we can move to the next slide, just to illustrate how labor shortages are really emerging as probably a top of mind for most organizations, is that job vacancy rates, and we've seen yesterday some numbers for September now, the number of job vacancies across Canada crossing the million mark. So there's more than 1 million jobs being unfilled as we speak. And when you look at the job vacancy rate, more than, they're pretty much double through the pandemic. And this is more acute in Quebec and BC, but clearly in across Ontario, including in Burlington, this is a very pressing issue. And again, this is not going to, there might be some kind of transitory factors in there with the hospitality sector reopening, and a lot of the workers that used to work there having moved on, create a lot of unfilled positions, and it's hard for those businesses to attract new personnel. But still, more fundamentally, this is a big issue that will persist for some time. If it can move to the next slide. Now, when we put it all together, I think from a honing in a bit more specifically on Ontario, and then I guess obviously the Burlington area, 2021. Because what was a recovery year from an economic perspective? We've seen activity bounce back significantly. Again, there's a base effect there. 2020 was particularly weak, so clearly we were expecting some big numbers and growth numbers in 2021, and we're by and large we're getting there. Although Ontario, there was because of supply chain disruptions, was held back to a certain extent. So we're not seeing a full recovery now in aggregate in Ontario. We think this is going to be much more of a 2022 story for this province and the region. Whereas in other provinces, in Quebec, for example, we've seen a big pop in activity. Yesterday, the Quebec government unveiled its mid-year or its fiscal update, in which it showed that growth has been, or they're expecting growth this year to be 6.5%, which is absolutely astonishing. But Ontario, because of those factors, we think the growth is being delayed a bit more. If we can move to the next slide, and this is where Ontario is going to shine a bit more in 2022 as those supply chain issues get resolved or at least ease, and so that we're expecting growth to barely not slow down that much. Whereas in the majority of other provinces, we're going to see growth slow down a lot more next year. Because most of the recuperation phases will be over, and then they will be running up against a capacity limitations, whereas Ontario has a little bit more room to ground to make up for still in 2022. So we're expecting growth to be a bit stronger in Ontario relative to the rest of most of the rest of Canada. But looking a little bit further out into 2023, in that case, now we're expecting that's when we're going to see Ontario slow down, because obviously 4.5% growth in roughly speaking back-to-back years is not sustainable, and in fact not quite desirable either, in the sense that we're already running against some capacity issues in the labor market, for example. And this should activity continue to then go above capacity, then it really started to raise longer term inflation issues at that point. So we think that this big run up in growth 2021, 2022, then we'll start to calm down and start to make its way towards a steady state in 2023. So this is, and obviously maybe just a last note of caution here. This is obviously in a world with there's tremendous uncertainty. I've mentioned a new variant now making headlines that could potentially cause, that has the potential to cause tremendous harm to our societies, but also our economies. But there's many uncertainties and risks that are coming from other fronts, from all the way from geopolitics, where we're having we thought we had a new U.S. administration that would be a bit more sympathetic to trade, but it appears that no, this protectionist reflex in the U.S. is going to stick around for a little bit longer, but it goes beyond that. So clearly our projections are based on a number of assumptions in a context of tremendous uncertainty out there. So I'm going to leave it at that. Now I want to make sure I leave enough time here for some questions. I believe I saw some questions popping up as I spoke, and since it's on the screen here, invite all of you to subscribe to our publications. Now you can get emails of all our reports, or you can select which reports you want to take. Me and our colleagues now provide tremendous coverage of all facets of the economy, as well as thought leadership, things that we think that every Canadians and Canadian businesses should be thinking about, from climate change all the way from to the labor and demographics, and the skills of Canadians needed in the future. So I invite you to subscribe to our publication. So I'm gonna turn it back over to you, Terry, I believe, and see if we have any questions.
Oh, thank you for that information, Robert. Very enlightening. Our chat's been active and people have been emailing me directly. So we've got a number of questions I want to get to. So from Colin in the chat, are the supply chain disruptions in some part the result of inventory drawdowns by OEMs during the pandemic?
Yeah, but those drawdowns in some cases are because there is that chain has broken at other I guess levels, right? And so many of those issues that, as far as I know, are kind of have their source in a shortage of microchips. But clearly, just the fact, I mean, it's a globalized sector, right? And the other sector, and when you have issues and transportation issues in terms of shippings and the ability of ports to manage the containers, this can cause a tremendous impact on downstream impact for a number of sectors and industry, and it's extremely complex. So I'm sure that the drop in inventories from OEMs and some major tier 1 parts manufacturers, for example, are part of this picture.
Thank you. So John W. in our chat is asking what's your forecast for the Canadian dollar versus the US dollar for the next year? I think it's what everybody's interested in.
Yeah. That's actually a good question. In a way, a boring answer, in the sense that our view is that the Canadian dollar will continue to trade within the range it's been trading for the last 4 or 5 years, which is now between the 70 and 78 cents and 81 cents US, somewhere around there, probably towards the higher end of that range. I think officially we have at the end of this year at around 79 cents or 80 cents, if I'm not mistaken, and ending 2022 around that level as well. But that being said, you have to expect a lot of volatility, which is absolutely typical of Canadian dollar, for a whole pile of reasons, but including volatility in oil prices, and as well as speculation in financial markets about which central bank is going to move first in terms of raising an interest rate. I mentioned the Bank of Canada in the spring. Now the Federal Reserve could move, so the central bank in the US could move also as early or maybe a little bit later. It's a lot of talks out there, and the timing of it could put some pressure either up or down in Canadian dollars. So all this to say that the trend is more or less kind of flatlining over time, but the reality will be huge fluctuations around that trend.
Oh, fantastic. For Esther, in your opinion, have supply chain disruptions dampened the size of the economic rebound? And could we have seen the disruption? This could have been captured more pent-up demand if we'd had the immediate supply available?
Yeah, but well, that's right. I mean, I don't see it as much, well, dampen at one point in time, but really the way we see it is more kind of delaying that activity towards a little later. Because as I've said, I mean, demand is there. I mean, was really the COVID recession was a supply side recession. It was a policy recession. One of my colleagues dubbed it the switch, the light switch recession, because the economic activity dropped because now governments, now authorities now turned the lights off for health reasons. And then as we turn it back on again, demand is still fundamentally there. And in fact, as I've said, because of the tremendous support that the governments have provided to household demand, our households in aggregate, again, I don't want to mean that's everyone. There are still many Canadians, and probably too many Canadians, who have struggled and continue to struggle, but in aggregate, there is a huge pool of savings out there that will help, that will support demand and go forward. So the fact that the supply has been unable to meet the demand at any points in time, in our view, is going to delay the activity until when those supply chain start working more normally.
Okay, so another question and a follow-up that I've gotten directly from other people is, how do you see the impact of GOP 26 outcomes on the Canadian economy?
That's yeah. I mean, it does pose. I mean, we have to go back to the previous U.S. administration and what it has done to Canada-U.S. relations, right? Now, that being said, as I mentioned, we thought that the new administration would completely turn things around, and clearly we've seen some improvement, but probably not as much as most of us would have hoped. So there's clearly a protectionist element in the U.S. that is going to persist. Now, whether 2026 what will happen there, it's still highly speculative at this point. But I think if we were to, draw some conclusions of what we've experienced so far, it's unlikely that we're going to see Canada-U.S. relations being on top of the agenda in the U.S. Yeah. I think we'll have to expect more of the same.
Yeah, I think that question might have had more with the global event that just happened in Scotland, but maybe I'll tie that into a next question around electric vehicles. So Canada is both a clean energy and a fossil fuel producer. With all the focus on electric vehicles coming in the future, how does that affect the Canadian economy?
Well, I mean, it could affect it either way, right? If we do nothing, if we don't invest in the technologies and products of the future, we'll fall behind. And Canada's could be many sectors of Canadian economy could be at risk. Or if we make smart decisions now, accept that this is the way of the future, there's tremendous potential. And in fact, when you look at Canada's technology sector and innovation and strength in many areas, I think there's tremendous potential to really rev up Canada's economy and allow our economy to thrive in the future. And we tend to be on kind of the latter camp. We think there's Canada's economy is going to benefit from this switch, and certainly in terms of if we do or when we do achieve our climate targets or emissions reductions target, our quality of life over time and for few generations also will improve. It can reduce the frequency of mega natural disasters that we were experiencing in a more frequent basis now. I think this will be all for the good. Now, obviously, from a regional perspective, when you look at Canada at large, I mean, there are some regions of the country, especially those heavy into the hydrocarbons production. I think there's going to be some big challenges there, but they're not insurmountable. I mean, we're seeing the industry, the oil and gas industry, making some big commitments in terms of reductions and becoming net neutral over decades, and they too, I think, stand to see some good potential to be successful in the future.
Okay, fantastic. Now, another question from our chat. Do you anticipate major banks reacting to the Bank of Canada anticipated rate hikes gradually and hike lending rates relative to the rate increase?
I think most financial institutions or most kind of the players in the financial markets fully anticipate. In fact, I'm not quite sure where the financial markets are right now, but not that long ago, they were expecting, they were pricing in 4 hikes in Bank of Canada hikes next year. Now we're at 3. So clearly, a lot of it is already started being priced in in financial markets. So I would not expect at all some kind of knee-jerk reaction. Come next spring, it'll be fully priced in. And that's part of the Bank of Canada's communication strategy as well, right? It's sending signals ahead of time so that nobody's spooked and everything kind of sort of runs smoothly. So in that sense, and from the way transmission perspective, now we're already seeing, for example, fixed rate mortgages starting having moved up in recent weeks and months. Eventually, we'll see variable the moment the Bank of Canada is going to start raising its overnight rate. It's going to translate very quickly to variable rates, but that too, I think, will be well telegraphed.
Okay, we just have time for a couple more questions. So this one came from our Political Action Committee, which is one of our volunteer committees at the Chamber. So solving our country's housing challenge should be a national priority. Canada has the lowest number of housing units per 1,000 residents of any G7 country, and the number has been falling since 2016. What are the factors you see as most limiting supply, and what, if any, are the long-term solutions to address the crisis?
Yeah, but ultimately there's a lot taking place at the local level. When you think of supply, I mean, there's just so much the federal government can do. Provincial has some power in there to influence, but at the end of the day, it really is much more locally the ability of or willingness of municipalities to allow higher density in existing neighborhoods, for example. There's a lot of resistance on that front, but ultimately, I think there has to be some acknowledgement that we need to move much more quickly to build up our housing stock, to make the housing stock much more responsive to when demand goes up very quickly. And Canada is in a very unique position in that our population is growing by far the fastest amongst the G7 countries, and that's something that non-Canadians don't really understand very well. But this very fast growth in population implies that there is a tremendous pressure to grow our housing stock. So there has to be some recognition and great efforts, especially at the local level, to be much more nimble in terms of turnaround time for projects approval, I guess push for those kind of the missing middle, those kind of mid-rise type of but slightly higher kind of, they call it gentle density kind of and move away from protecting at all costs those the very restrictive zoning bylaws to make those a bit more flexible. It's obviously very, very complex, very at times very controversial. But what I can see more and more is that there is some movement on that front, and we've seen Toronto, for example, starting to be a bit more open about being more kind of going towards the inclusionary zoning, for example.
We've got one last question here. So this is becoming a real political issue in the next provincial election regarding 413, Highway 413, or the Bradford bypass. You indicated that transportation was the largest driver of inflation. Can we assume that the government should have transit solutions as a major priority to combat this? And if it's not improved, how significant a drag can this be on the economy?
Yeah, but most of the component in terms of for that CPI item, it really is gasoline. So it really is the transportation is the cost of filling up your gas tank, and anyone who's done that recently knows very well that it's much more expensive to do so than a year ago. So clearly this will kind of run its course in the coming months, but still, I think that there is some tremendous room to continue to invest, especially in public transit, for example, to offer more kind of affordable options for those Canadians with less means to transport, to go to their work, and in a more timely on a timely basis. So I think those investments are absolutely well worth it.
Well, thank you, Robert. On behalf of everyone here today, I want to thank you very much for providing us with such insight on what to expect for 2022. And thank you to our sponsor, RBC.